If you're working a deal and you're a few $1,000s apart between buyer and seller agreeing to terms, there's one thing that you're probably forgetting about that maybe you can negotiate to help push the deal to the finish line, and that's called the allocation of assets. The allocation of assets is something that is very rarely talked about on the front end when negotiating the initial terms or a letter of intent on a practice purchase or practice sale. Let's talk about it. So you have $1 million purchase price using easy numbers. And how is that $1 million going to be broken up for tax purposes? What helps the seller hurts the buyer. What helps the buyer hurts the seller. So it is a point of negotiating that needs to be talked about. But again, this is something that if you're close on being able to agree upon terms, that can help bridge the gap, because you move the needle $100,000 in allocation, not purchase price, in allocation one way, that could save the seller potentially $17,000 in taxes, and that might be able to get your deal done. So that's why it's super important. So here's why it makes sense, and here's what you need to know at a high level. So goodwill is taxed as capital gains, advantageous for a prospective seller, because generally speaking, the tax rate on capital gains is 20%. Whereas fixtures, furniture, and equipment is gonna be taxed as ordinary income. Depending on your tax bracket, let's just use the highest tax bracket, 37%. As you can see, there's a delta there of 17%. So a seller wants as much as possible allocated towards goodwill, whereas a buyer wants as much allocated towards fixtures, furniture, and equipment. So let's flip the script and talk about the other side. Greg, why does a buyer want as much as possible allocated towards fixtures, furniture, and equipment? And it's because different things can be depreciated at different speeds. So for fixtures, furniture, and equipment, the depreciation rate is between 5 and 7 years, whereas on goodwill, it's 15 years. So you can't take as much of a tax write-off on goodwill immediately as you can fixtures, furniture, and equipment. Okay, so now that we understand how it hurts and helps each party, let's put in perspective of, Greg, we have $1 million sale price. How do we know how much to allocate to each category in each bucket, right, as we keep calling it? And it really varies on the type of practice. A lot of practices that we see of doctors that are retiring, frankly, they're old and dated. They don't have brand new equipment. So due to that, the fixtures, furniture, and equipment value is gonna be less. But I would tell you, if we looked at 10 deals, probably 8 of the 10 are gonna have an 80% allocation towards goodwill and a 20% allocation to fixtures, furniture, and equipment. But again, it varies. That's a rule of thumb. We don't wanna get caught up in rule of thumbs, because they can get you in trouble. Because what if you have a practice that maybe the seller, before putting their practice in the market and retiring, did a re-equip? Maybe they bought ADEC chairs, they did a CBCT machine, they bought a CEREC machine. Long story short, they invested $300,000 in the last 5 years. Are you gonna be able to allocate 80% to goodwill in that scenario? Probably not. But on the flip side, if you have that practice that's super dated, you might be allocating 90% to goodwill. But rule of thumb, 80% allocated towards goodwill, 20% allocated towards fixtures, furniture, and equipment. So with all that said, quick disclaimer, we are not an accounting firm, we're not a CPA firm, we can't give tax advice. You need to consult your CPA or your accountant to get verification on all these things, as you always should. Don't just take some random person's information off the internet and believe it. But if you have any questions, feel free to reach out to us, we're here to help. Take care.